You're listening to Capital Topics, episode number 77. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In our podcast today, we will review the global capital markets performance for the first half of 2025. Enjoy! Good morning, James. How are you today?
I'm really good. And how are you, François?
I'm good, thank you. So, we have officially reached the halfway point of 2025. And today, as usual, at this time of year, we will be looking at what's been shaping the markets over the past 6 months with a review of global capital markets performance. One thing is for sure, it's been anything but dull.
Well, you really said it well, François. It has been very exciting since the beginning of the year, so fasten your seatbelt sort of market. The difference this time, though, François, I would say, is that many investors blame the market volatility on the chaos manufactured, and I choose that word carefully, by what's happening in Washington. Mm-hmm. And, of course, all of the nasty stuff happening geopolitically around the world. So the first half of the year has been wild, a wild ride, and I guess we could call it a masterclass in unpredictability.
Correct. And we will cover all that and more in today's episode. But before we start, I would like to remind our listeners that the market performances I will be sharing with you today can be found on our Capital Topics website in the resources section or directly on our team's page on the PWL Capital website. We believe these market statistics are a valuable tool to follow today's discussion and to review the performance of your own portfolios.
I would also like to add for our listeners, François, that they can find the performance of our model portfolios on the Capital Topics website in the resources section, or they can find it directly on our team's page at PWL Capital's website. Again, I think that reviewing the performances of our model portfolios is really a great way for our listeners to evaluate the performance of their own portfolios.
Yeah, and that being said, let's move on with our review. Where would you like to start, James?
Well, François, I mentioned earlier that this first half of the year was a masterclass for managing your emotions, given the unpredictability of what was happening in the world. So many events affected the markets, and all of them were totally unforecastable. First off, I think that President Trump's aggressive start to his second term by launching tariffs, again, against major trading partners really started the ball rolling.
Yeah, I totally agree. The most impactful for the market was the new tariffs announced under the Liberation Day economic strategy on April 2nd, 2025, obviously. To make matters worse, President Trump announced additional new sweeping tariff. The announcement shocked investors due to its scale, speed, and unpredictability. It reignited fears of global trade war and triggered one of the most dramatic equity market sell-off in recent history. Within 2 or 3 days, this announcement wiped off trillions in equity value across the globe. Here in Canada, the S&P TSX Composite lost 12.2%. The MSCI EFI for international equities lost 13.2%. And the S&P 500 in the U.S. lost almost 15% at 14.7%.
To be fair, François, I would add that President Trump had been threatening to impose tariffs on multiple occasions in the past. But I think what surprised the markets the most was the scale and also the plan to impose a 10% baseline duty on all imports.
Yeah, correct, on all imports. And that negatively surprised the markets, and not only the stock markets, but also the bond market. The bond market response may have been even more consequential when the U.S. Treasury yields spiked, since it ultimately forced the White House to hit the pause button.
Exactly, François, and many believe that this is what forced President Trump to announce a 90-day so-called temporary pause on tariffs on April 9th. To me, this was the bond market telling the Trump administration that they better be very, very careful about their economic policies. Normally, when stocks fall, investors turn to the safety of government bonds, and that sort of pushes the yields down, and therefore bond prices go up. But this time, the opposite happened. Yields increased and bond prices went down because investors feared that the tariffs would reignite inflation. So add to that the international investors' sentiment about increasing U.S. federal deficits. That could actually trigger foreign selling of U.S. Treasury bonds.
Correct, James. But again, it's the unpredictability of all this that baffles me. The pause to the tariffs started with a single, very brief message from President Trump on Truth Social at 9:37 the morning of April 9th, when he posted, "This is a great time to buy." A few hours later, in the afternoon, he formally announced the 90-day pause. The markets reacted strongly and produced the biggest single-day gain since 2008. The market psychology went from fear and panic to euphoria, all in a span of 7 days.
Well, it's my opinion, François, that the stock market, which everybody follows, and most people don't follow the bond market, really woke up and the stock market now feels comfortable that the bond market will help protect them. That's, again, just me speculating. So, again, the relief rally, as you pointed out, was extraordinary. The S&P 500 surged 9.5%, the NASDAQ jumped 12%, and the Dow gained 8%. And all of that in that one day, April 9th.
James, I think this is a perfect example of why we don't try to time the market. If an investor had sold when the tariffs were announced on April 2nd, but failed to reinvest when the markets bottomed on April 7th, only 2 trading days after, this investor would have permanently damaged his portfolio.
Well, François, I think it's a great reminder that reacting emotionally can be costly and undermine the performance of our portfolios. As we've said many times on our podcast over the years, market timing is not a strategy that our listeners should follow. So what else happened in the first half, François?
Well, James, on the geopolitical front, there was plenty to worry about. There's still this lingering war between Ukraine and Russia, and obviously the heightened global trade tensions. Also, especially what's going on between the two superpowers, the US and China. Add to all that the development in the Middle East, particularly the latest events in the war between Israel and Iran.
Yes, well, again, the targeting of the Iranian nuclear sites, again, totally unpredictable. As a result of this, the price of oil jumped instantly by 16% up, that is, from under $70 a barrel to over $81 a barrel. So when the U.S. brokered a ceasefire, well, a brokered is a big word. When Trump kind of imposed a ceasefire on both parties, the price of oil came down as quickly as it went up when fears diminished.
Yeah. Again, all that very unpredictable, and no one could have guessed when Trump would brokered or announce a ceasefire. So trading on the oil would have been very difficult to do. Again, totally unpredictable, and thankfully, compared to past conflicts like the 1973 oil embargo or the 1990 Gulf War, the spike in the price of oil was short-lived. Now, turning to the economy, inflation continues to moderate globally. In Canada, inflation has dipped below 2% in April. It now sits at 1.7% versus 2.7% in May last year. This has helped the Bank of Canada to reduce its benchmark interest rate from 3.25% at the beginning of the year to 2.75%. Looking at GDP, Canada's economy is growing, although at a slow pace. It even contracted slightly in April versus May, but year over year is still expanding at 1.3%.
I would add to that, François, that in the U.S., the situation is somewhat different. Inflation rose in May, back up to 2.4%, and this is well above the Fed's 2% target. But it's still much better than it was a year ago in the U.S. when it was at 3.3%. However, despite this improvement, there's a battle between the Federal Reserve and President Trump. And so the Fed has left the Fed funds rate unchanged so far in 2025 at 4.5%. But the reasoning is that the economy in the U.S. remains resilient and the labor market is particularly strong, with unemployment even decreasing to 4.1% in June. So that's significantly below Canada's rate. All of this despite the pressure from President Trump to lower rates. Jerome Powell, the Fed chairman, has remained firm and he's kept the rates unchanged, walking a tightrope between controlling inflation and avoiding a growth slowdown in the economy.
Yeah, totally. And elsewhere, the ECB, European Central Bank, cut its key deposit rate to 2% in June after the Eurozone inflation eased to 2%. In the UK, the Bank of England, which is dealing with persistent inflation now, which is at 3.4%, still trimmed its rate twice this year to 4.25%.
To conclude on the economy, François, I think it's fair to say that across the board, central banks have been cautiously shifting towards easing as they are trying to support growth, but without igniting inflation.
Yeah, I agree, James. Now let's look at the market statistics for the first half of 2025. Again, as a reminder, our statistics can be found on the Capital Topics website and in our teams section on the PWL Capital website. We'll provide a link for the market stats with this podcast page. Okay, so starting with fixed income, the yields in Canada and in the US remain well above the average yields available in the last 20 years. In Canada, the yield on the benchmark 10-year Government of Canada bond was roughly 3.3% on June 30th, almost 80 basis points above the 20-year average of 2.5%. In the US, the yield on the 10-year Treasury note on June 30th was unchanged compared to a year ago at roughly 4.4%. And this is 150 basis points above the 20-year average of 2.9%. The Canadian short-term bond, which are at the core of our fixed income portfolios, delivered decent performance in the first half of the year, returning 2.2%. And this was better than the performance of the Canadian Universe Bond Index that generated 1.4%. And over the last year, however, their performance was very similar at 6.3% and 6.1% respectively.
Yes, François, and those 6% returns really include a capital gains component. So, but compared to the pandemic years, the yields on Canadian bonds are still attractive, paying out between 3 and 3.5%. This continues to be very good news for investors who have a significant portion of their portfolio in bonds. So now, François, let's have a look at what happened in the equity markets around the world.
Well, James, the first half of the year has been surprisingly strong around the globe, despite all the noise around the tariffs, the trade wars, and the difficult geopolitical landscape. Here in Canada, the S&P TSX Composite has performed quite well with a performance of 10.2% year to date. Much of that strength has come from the energy and materials sector, and especially from gold producers who have seen the price of gold reach record highs. For the last year, 12 months, the S&P TSX index returned 26.4%. Very good performance there.
I agree. That is incredible. I think, François, though, we can say that a lot of investors are going to be really surprised with the performance of Canadian stocks. I mean, Canada has been at the center of President Trump's negative rhetoric on tariffs. We would have expected that would have had a negative impact on the Canadian stock market. It's certainly impacting the economy. But no, the market's up substantially. So now, François, let's take a look at U.S. stocks.
Well, markets in the U.S. have been on a roller coaster ride this year. By early April, the S&P 500 and the NASDAQ were both in bear market territory after losing more than 20% from their previous highs. That correction was sparked by tariff tension, valuation concern, and geopolitical risks. But then came the rebound. Once the U.S. paused the tariffs in April, market sentiment shifted, and we are now reaching new all-time highs on the S&P 500.
Yes, it's been a remarkable turnaround for U.S. stocks from the lows of April on the S&P 500. It's now roughly up, I think, about 28.5% from those lows. This is, again, a very powerful upswing, and that's why you want to stay invested at all times. Like I mentioned before, if an investor sells at the bottom of the market and misses a big upswing, the investor will have permanently impacted their capital and consequently their long-term returns.
Yeah, I totally agree, James. But despite these huge swings, the U.S. Market is up only 5.8% year to date as of the end of June. That's in U.S. dollars. And Canadian dollar, it's up 0.2% because the Canadian dollar gained versus the U.S. since the beginning of the year. For the last 12 months, the U.S. total market index is up close to 15% in both Canadian and U.S. dollar. So the Canadian index S&P TSX is doing almost 11% better than the US for the last 12 months.
Wow. So, François, I think it's fair to say that the U.S. dollar has been under pressure against a lot of other major currencies year to date. From my readings, the U.S. dollar fell 10.8% against a basket of currencies that includes the euro, the yen, the British pound, and others. This can be explained by many factors, such as trade instability caused by the tariffs, fiscal concerns around the big, beautiful bill that was just adopted, the U.S. Credit downgrade in May by Moody's didn't help, and finally, the potential Fed rate cuts later this year, which would further weaken the dollar.
Yeah, that's correct, James. The markets hate uncertainty, and with everything that's happening in the U.S. right now, I think the dollar's safe haven premium is eroding and questioning its role as a global reserve currency. To finish with the U.S. equity, small cap stocks have been struggling this year as they are down close to 7% year to date. That's in Canadian dollars.
I think we can also add, François, what's being reported in the financial media that international investors are apparently reallocating away from U.S. equities to international equities. Again, sure. I think they're concerned about valuations, but again, I think also, the chaos around Trump has created a lot of negative sentiment. So, François, that said, we can now share with our listeners what has happened in international, developed, and emerging markets.
Sure, James. I can report that both markets had very good performance. Developed international equities measured by the MSCI EAFE is up a strong 13.2% in Canadian dollars year to date. In local currencies, it's up 7.8%. The difference in return is due to the fact that the major currencies in that basket have gained against the Canadian dollar. As in 2024, international large and mid-cap value stocks continue to outperform growth stocks as they returned 16.4% year to date compared to 9.9% for growth stocks. Contrary to the US, small cap stocks continue to do well, and they outperform their large and mid-cap counterparts with a performance of 14.5%. That's in Canadian dollars. And emerging markets also had a good first half. Large and mid-cap stocks generated 9.5%, again in Canadian dollars, and small cap stocks delivered a decent return of 5.1%.
So overall, François, I guess we can say that the first half of 2025 has been very volatile, but investors who stayed invested with diversified global portfolios did well. As we said earlier, although the first half of the year was a masterclass in unpredictability, from equity market meltdowns to spectacular rebounds, to the tariff soap opera and to the geopolitical tensions, there was plenty to worry about. The markets taught us once again that staying disciplined to our long-term asset mix was the best option.
I agree, James. And while we can't predict the second half of the year, we can prepare for it by staying grounded in evidence and clarity. And that's really at the heart of our message. Stay disciplined, stay diversified, and stick to your financial plan. Keep your portfolio patient and your perspective long.
Well said, François. I think we can conclude our mid-year market review for our listeners right here.
Yep, correct. Thank you, James, for sharing your thought and expertise today.
My pleasure, François.
So that's it for episode 77 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for our next episode to be released on August 13th. In the meantime, make sure to consult the Capital Topics website for our latest blog posts. See you soon. Thank you.